It's official. IMF warned of significant credit disruption and harder landing. Why recession is a lock for 2023. Why risks are weighted heavily to the downside. People already think that we have had the crash and that it's a new bull market, when we have only seen the first half of this bear market. We have eaten the appetizer. We still have the main course. The only people saying this isn't 2008 are the people that haven't experienced it or are paid to say otherwise. U.S. Treasury Secretary Janet Yellen said today, the U.S. economy is performing exceptionally well. She said U.S. debt could go north of $50 trillion in the next decade, but that's not a problem at all. Why? I will get to it later. People who take a paycheck can never say what they really want, whether it's real or fake. It's like when Elon said, you know it's real because it looks so fake. He also said Warren Buffett should run the U.S. Treasury. He could do a better job in under 1 hour per week. Why IMF warns a harder landing for the economy. When Yellen said the economy is performing exceptionally. Why recession is a lock for 2023. Why IMF warns risks are so weighted heavily to the downside. I will explain it all right after this.
How you like that? How you like that? Nah. Look at you, now look at me. Look at you.
Welcome back everyone to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do, and push my button, the like button, if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you're a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You want to be my client, don't you? And here is my client's collaboration book. It's already yours. Adversity Equals Success. Such an amazing book with such incredible authors. Order your copy today. Here is my client Eazzy's book. It is a femdom novel, and it's about money, stockings, and the stock market. Such an amazing book. Wicked Pussy Perfume. Order your copy today. Oh, and a shout out for my amazing client, Eazzy. Sometimes sentiment is so bullish. It's actually bearish. In 2021, everyone is so bullish, it pays to be bearish. Right now, I think we are at the edge of a long cliff. Because according to inverted yield curve, we are as inverted as ever. But the deflationary crash happen is when yield curve uninverted or going back to normal, which it hasn't happened yet in the markets. But it's sure as hell going to happen. For the same reason that if you got pushed down, falling down, face down, ass up, you will get back up and face the music again. The IMF is warning of high uncertainty and risks as sticky inflation and financial sector stress adds to pressures emanating from tighter monetary policy. GDP will likely expand 2.8% this year and 3% next year, each 0.1% less than forecast in January. The fund said in its latest forecast. That compares with 3.4% expansion in 2022. In a plausible alternative scenario with further financial sector stress, to which the IMF assigns a 25% probability. The IMF warns that worldwide growth could decline to about 2.5% in 2023, with advanced economy growth falling below 1%. Last week, the IMF warned growth over the next 5 years will be limited. That's based on risks from economic fragmentation caused by geopolitical tension, including the escalating US-China rivalry that reinforced by the war in Europe, as well as slower labor force growth and decelerating long-term rates of expansion in China and South Korea. Additionally, in a new addition to the report, the IMF is now forecasting inflation. It's projected that worldwide headline inflation is set to fall from 8.7% in 2022 to 7.0% in 2023, but 0.4% higher than the January projection. On the back of lower commodity prices, but underlying core inflation is likely to decline more slowly. Inflation's return to target is unlikely before 2025 in most cases. The unexpected failures last month of Silicon Valley Bank and Signature Bank and the collapse of Credit Suisse Group roiled markets and ignited financial stability concerns, complicating central banks' quest to tame inflation while maintaining growth and the health of the banking system, sparking IMF concerns about financial sector instability. The risks are weighted heavily to the downside, in large part because of the financial turmoil of the last month and a half, said Pierre-Olivier Gourinchas, the fund's chief economist. That is under control as of now. But we are concerned that this could result in a sharper and more elevated downturn if financial conditions were to worsen significantly. To that end, in one forecast scenario, which it calls a plausible alternative, financial instability remains contained but impacts conditions more than in the IMF's base case, and banks reduce lending. That would cause growth to slow to 2.5% in 2023, the weakest pace since 2001, in a severe downside scenario, to which the IMF assigns a 25% probability. There could be significant credit disruption, and the pace of global expansion could slow to less than 2%. Something that's only happened 5 times since 1970. There's also about a 15% probability of growth at just 1%. We can all remember the long time between the failure of an individual institution, whether it was Bear Stearns or countrywide, he said, referring to institutions that failed more than a decade ago. Every time this was treated like an isolated incident until it wasn't. In its twice yearly full forecast published on Tuesday, the IMF said the turmoil in the UK government bond market last autumn and last month's US banking turbulence showed the significant vulnerabilities that exist both among banks and non-bank financial institutions. Risks to the outlook are heavily skewed to the downside, with the chances of a hard landing having risen sharply, the IMF said. Additional risks beyond the financial sector include inflation taking longer than expected to slow, China's reopening faltering, or a worsening of the Russia-Ukraine war. We're seeing a lot of downside risk going forward, Audacious said, hinting that central banks are caught between a rock and a hard place. While on one hand it warns of financial stability risk brought on by sharp rate hikes, the IMF has also warned of a hard landing for the economy if persistently troublesome inflation keeps interest rates higher for longer and amplifies financial risks. He warned that below the surface, turbulence is building and the situation is quite fragile. Inflation is much stickier than anticipated even a few months ago, he said. More worrisome is that the sharp monetary policy tightening of the past 12 months is starting to have a serious side effects for the financial sector. So long as financial markets remained relatively stable, central banks should do everything they can to beat inflation. The fund said. He warned price pressures could continue to prove more persistent, which would result in a harder landing scenario. There is a concern out there that we may not have enough tightening in the system at this point, and more will be needed, he said. That would certainly increase the odds that output would come down further compared to our projections. However, a credit crunch, which some economists are predicting in the wake of the recent U.S. banking turmoil, could act as a disinflationary force, he said. As long as it is orderly, some of this lending contraction may actually be beneficial in terms of bringing down inflation and may substitute for further interest rate hikes. Okay, what's a credit crunch? A dramatic worsening of a firm and consumer access to bank credit is how a 2014 paper on the Federal Reserve describes a credit crunch. Securing a loan or a credit line has gotten tougher since the Federal Reserve started jacking up interest rates. But the recent banking crisis is raising concerns that lending standards will tighten even further, resulting in a potentially harmful credit crunch. Nearly 45% of banks made it more difficult for businesses to obtain commercial and industrial loans in the fourth quarter of 2022, according to the Federal Reserve Survey of Senior Loan Officers. Back to Elon Musk. Musk weighed in why Buffett can do a better job as Treasury Secretary after Yellen appeared to shrug off a potential increase in America's debt pile from about $32 trillion today to north of $50 trillion over the next decade. Yellen told Congress in March that wouldn't be problematic if the real net interest cost of the debt remained low and the government pursued a sustainable fiscal policy. Buffett has jokingly expressed interest in holding the cabinet position in the past. I'd love to be Secretary of the Treasury if I knew I could just keep raising money at negative interest rates. That makes life pretty simple. If $50 trillion in debt is no problemo, that's why they say Bitcoin could go to $1 million. Look, it's already back to $30,000 again. You are such a good boy for watching my video. You are such a good boy for watching my video right till the end. Bye.